So this will be a ripper because we've got two of the best two of the great investment houses on the Australian Stock Exchange in Soul Patts and Regal. And I was thinking, who will we go with first? I was thinking, well, Phil's telling us he's got near $19 billion under management, but then I thought, no, market cap's the better place. So we're going to go with Todd. He's got $16 billion market cap.
He's got a few years on us as well.
Yeah, that's right. Yeah, almost 100. I think it's 99. So Todd, thanks for coming along. It's been an interesting few years for Soul Patts. So two big deals in the last 4 years. 2021, you had a takeover bid for Milton, big ASX LIC, listed investment company. You took that, gave you a lot of liquidity. You diversified that money. You sold down the share portfolio and diversified. And of course, you moved forward 4 years and your old sister company, Brickworks, after all these years, the cross-shareholding at last is being unpicked and the companies are coming together, which gives you exposure to bricks, obviously, and a massive industrial property portfolio in the joint venture with Goodman. So it's pretty exciting times. But the question is, big diversification in the last little while. You've taken that money, you've gone into private debt, more private equity, you've got more exposure to bricks, more exposure to industrial property. And I'm just kind of love to know why Soul Patts, this traditional equity house, has decided diversification is the way to go.
Yeah, thank you. I think the interesting thing about looking at the history of Soul Patts is people think it's an equities house, but actually it was an operating business when it was the chemists, and then when they moved into investments in the sort of second half of the last century, there was a variety of investments, and a lot of those were private equity before private equity was a commonly understood asset class. So two of our biggest assets today in TPG and New Hope started out as private equity investments. And so really it was about, when I looked at our competitive advantages that we have in building our business, one is the permanence of our capital. So we have that ability to take long-term views. We're not worried about short-term fluctuations in performance and the risk of redemptions and things like that. And secondly, the flexibility that we have. We can do anything, go anywhere, and take advantage of really interesting opportunities that we see. So it was about how do we capture that. And if I go back 5 years ago, we were almost a victim of our own success in the sense that 75% of the portfolio were these large companies that had been in the portfolio for a long time with really low tax cost bases. And for us to diversify into other things would have resulted in a big tax leakage. And so the Milton acquisition gave us access to new capital to diversify. And Brickworks is really just an extension of that journey that we've been on in the last 5 years. It does increase our allocation to private markets. Pre-Milton we were under 10%, and post-transaction with Brickworks will be about 45% allocated to private markets.
And I said to you, we had a chat during the week, and I said to you, what about liquidity? That these private equity investments, they're not that liquid. You've got to sell the whole thing, and it's not like being in listed investments. And you said, well, we don't always need liquidity. Do you want to elaborate on that?
Yeah, well, I think everybody should take a thoughtful approach to liquidity because everyone runs towards it, but you actually only need a certain amount of liquidity for living expenses or whatever you might have. And in our case, our liquidity needs are to pay our dividend. We pay our dividend out of the cash flow that we generate across our portfolio every year. So we actually don't need liquidity from our portfolio other than to recycle into new ideas. And we're not turning over the portfolio every year. So when you actually sit down and think about what your liquidity needs are, then you can start thinking about having some illiquid assets because then you can capture that premium for illiquidity and you can invest in longer term assets. And so I think people are probably over liquid in most cases.
Yeah, Phil, you've done, it took Soul Patts 120 odd years, you've done it in about 3.
No.
In 2022, you took over VGI, which was a listed management company, and that became your vehicle. And since then, you've really diversified. You've gone into a whole range of interesting alternates, as we call them these days. There's mining royalties, there's water, there's private debt, and of course, equities. But you went out of Australia global as well, so you diversified there. Give us a little bit of insight why, given you're an equity, you worked at Macquarie and you worked in London, it was all about equities, and now you've got a show bag of assets.
Yeah. Show bag.
Lots of goodies in there.
Shopping trolley. Look, one thing I found in the first 10 years or so of running Regal was that our investor base was very different to what was our investor base back in London when I worked there. And when I was in London, we had a lot of third and fourth generation family offices. A lot of these family offices were very sophisticated investors. They would build diversified portfolios, but they'd outsource the investing. Whereas a lot of our investors in Australia were very different. We had a lot of first and second generation wealth. A lot of those investors wanted to do things themselves, and they wanted to, invest in equities and probably overexposed to equities and property. So, one of our goals has always been to diversify our business and to diversify our investor portfolios. And so it's been actually probably a 10-year journey for us to diversify, and it's exciting. And we've gone into things like private credit, where we still think there's huge opportunities. Getting double-digit returns without the volatility of equities. We've gone into some more niche markets like water, electricity, and one of the things we like about these niche markets is when you have capital and other people don't, you can get paid for liquidity. And you also find some of these more niche markets are less efficient than, say, listed equities. So that's been an opportunity, and the other things we're very excited about at the moment are small caps and resources.
We'll get to that. Don't get too excited, because we all like that end of the market. But just interesting. Todd told us about for Soul Patts, and we know that story very well. They've got us hooked on this increasing dividend stream, which has been a terrific scorecard for them over the years, and they've done really well. Your scorecard, given you're a manager, is about double-digit returns. Is that what you're looking for? And is that in the different investment classes, and is that sustainable?
Yeah, look, we're very focused on our investor returns, and we think we can get double-digit returns in the medium to longer term across all our investment classes. I think, obviously things go through cycles, but certainly, I think all aspects of our business have a very positive outlook at the moment. Yep. And Brendan's here today. He's our CEO. I'll let him worry about the share price, and I'll stay very focused on the investing side.
I know he's very worried, so you can relax. Todd, let's just talk a bit about some of the assets you've got. One I'm really interested in is private credit, because private credit's 10 or 15 years ago, there wasn't much about, but now both Regal and Soul's have gone into this area, and debt always worries me. Now, we know that the banks, the big four banks, have moved out of funding a lot of small and medium businesses, but you guys see yourself as maybe in a unique position in private credit, and that can grow for a fair bit longer, and it does deliver these kind of returns.
Yeah, I mean, we do it a little bit differently to most, but I would say as an asset class, it's quite funny, because whenever anyone talks to me about credit, they talk about the risks, and whenever anyone talks to me about equity, they talk about the upside. And the perversity of that is that when things go wrong, equity gets wiped out before credit suffers $1 of loss. And so we actually see credit as a downside protecting mechanism, and a very defensive way of still being able to extract decent returns, probably better than what we can get out of equity markets, frankly. But with that liquidation preference and that elevation in the capital stack, that if things go wrong, we're protected. And so we really like it for that reason, and I'd frankly add a lot more to the portfolio if I could. The problem is getting access to it. It's not an enormous market here in Australia. There's increasing competition, no doubt. But I would say that the way that we are doing it is a little bit like the way that we do everything in our portfolio. We extract maximum value out of the competitive advantages that we have, and because we have that flexibility, we can take a longer term, more equity-like view of the asset class. So we're looking at it saying, well, would we be happy to own the equity in this business? And if we can come up with an equity value, then we certainly should be thinking that the debt is safe. And then we utilise that to present a flexible solution to people who are looking for capital, and we can have a conversation about equity or debt, and it doesn't really matter, and we can take it in any direction. I think that's fairly unique in the Australian market. I think most people are a little bit more middle of the road in terms of their approach to private credit. But I actually see it as a much less risky asset class.
Phil, you've done the same thing, Regal. Yeah, one in private credit. It's one of your high growth areas, and I gather you're still very bullish in the sector.
Yeah, like Todd, we see a tremendous opportunity there, and like Todd, we see an opportunity to provide the whole capital structure. And, you know, we also are very focused on resources as well, and we can offer companies not only credit and equity, but we can offer resource royalties as well. And sometimes that suits mining companies who don't want the leverage from borrowing money, but don't want the dilution from equity. And so, yeah, I think there's great opportunities there. We have one team focused on property, and then we have another team focused on businesses. And like Todd, if we're happy to own the equity, why shouldn't we lend the company money?
And we've seen in downturns, in previous cycles, I know it's been a while now, that banks and lenders can get into trouble with businesses. It can move fairly quickly in a cycle. Does that worry you?
Well, I think the key there, Matthew, is the fact that banks run 20 times leverage and our private credit funds basically aren't levered.
Right.
And so that's why banks get themselves tied up, because one, they get themselves too levered, and secondly, they have a liquidity mismatch where they offer, deposits, let people take money out whenever they want, and then the people borrowing money don't have to pay back until, their loan schedule. So, the banks are, in some ways quite dangerous, and that's why the government has to stand behind them and protect them, because they have huge leverage and a liquidity mismatch, and we don't have that in our credit funds.
Yep. Todd, with the Brickworks acquisition that votes tomorrow, so we cross our fingers that all goes through and then you own 100% of it, but it gives you exposure, I said earlier, to a few, or more exposure to certain industries for going from 43% to 100. One of those is obviously bricks. Housing cycle in Australia at a low for a couple of years now. It seems like it wants to pick up. You're getting Brickworks or 100% of it at the low of the cycle. Do you have a view what it looks like 4 or 5, because you've got that long-term view, the future for bricks and housing in Australia over that period?
Yeah, that was definitely part of our thesis, was that we were picking up an asset at the bottom of the cycle, which is in our nature. And if you look at the history of new housing starts, it is a very defined cycle, and we are at the low point right now. But we're also at the low point at a time where the number of houses that haven't been built to accommodate the new immigrants and things like that we've got a record high underbuild of houses. So it has to happen. We do think it will turn. I take some comfort from the fact that a lot of the publicly listed building products businesses are being privatised. You talk to a lot of the private equity guys around the world, and they're on the hunt for building products assets. I can't tell you when it's going to turn, but certainly we.
But there are some bottlenecks. That's part of the problem. There's cost issues that stop the cycle getting really going.
Yeah, I think there is some bottlenecks in terms of the availability of trades, the cost of construction, the regulatory intervention in getting new land released and things like that. The good thing is all of those things are being looked at and they're now sort of top of the agenda. So I think, again, that's going to be something that will factor into the turnaround.
Phil, you mentioned before that you're small caps. So you're not out of equities. It's still a core part of Regal's go forward. You don't see the overall Aussie market as attractive?
I see large caps in Australia as very expensive, and we've got one of the highest multiples in the Australian market, and one of the lowest growth rates compared to overseas markets. And it's no surprise that, in the index changes that were announced on Friday, that there's 3 companies from overseas coming to list in Australia because they want to take advantage of our high multiples. And so that's the large cap end of the market. We've got a record underweight to the top 50 in some of our long-short funds, but we're very overweight small caps. And one of the big reasons we think that small caps have been so left behind in the last few years is because of the industry funds. And I'm not blaming the industry funds if there's any here. They're just doing what the government has told them to do. And the government is judging the industry funds by the cost of managing money. And so the industry funds have had the natural response and moved into some of the lowest cost areas of managing money, and that's the large caps in Australia. And so they're investing in large caps in Australia, and in my mind, this is like the government telling the Navy, buy the cheapest submarines you can, and don't worry if they leak or don't worry if they cause you problems in the long run. I think the government's causing problems for our stock market by telling the industry funds to manage money as cheaply as possible. But the result of that is that the industry funds have been selling small caps for 5 or 10 years and buying large caps. And we think that's created an opportunity.
Well, you made the interesting comment to me that you can't index
Small
Small
caps.
caps. You've got a stock pick.
Exactly. And if you look at our small cap fund, I think we might have annualised 20% over 10 years or so. That's not our small cap fund, but similar sort of pattern. But we've made about 20% on our small cap fund. But I think around 2/3 or 3/4 of that have come from stock picking, and only about 1/4 has come from beta or the small cap index going up. But what we really like at the moment is we think there's going to be tremendous alpha and beta opportunities in small caps over the next 5 or 10 years, because we think they're, on a relative basis, very cheap.
And particularly resources, where you're calling it the golden age.
Golden, that's a good one. Supercycle, I was going to say. But,
Okay. Well, you told me this is the golden age
maybe.
of small caps or particularly resources.
Yeah, very bullish resources. And I think, we turned bullish a number of years ago just because of what we were seeing on the supply side. It's so hard to build new mines these days. And I think even overnight we saw Anglo announce a takeover for Teck. All the big boys know that, BHP, Rio, Glencore, they're all trying to buy existing assets rather than invest in new capacity, which is what they did in the last cycle. And as a result, for most commodities, there's very little new supply coming in. And we've done well out of gold recently, and the gold price has doubled in the last 2 years. But we compare it with the rally we saw last time, 20 years ago, when gold went up 6x in 10 or 12 years. And so I'm not saying it's going to $16,000 or anything like that, but I think there's tremendous upside left in the gold price. And on the supply side, it's very constrained. We saw the McPhillamys mine in New South Wales recently get rejected by the federal government. CapEx bills are going through the roof. It's very hard to build new mines. But on the demand side for gold at the moment, I think you've got the best buyer in the world, and that's global central banks. And they're diversifying away from US assets, US treasuries. We saw recently they've got more money in gold now than they do in US treasuries. And we think, their checkbook is basically, the biggest checkbook in the world, and they'll keep buying. And as the gold price goes up, I think it's going to suck in a lot of retail. So very positive on gold, and, we're watching other commodities like copper and uranium as well, because we think we could see huge bull markets in those as well.
Okay, just ponder there for a sec, but I want you to think about a couple of stocks you can tell us in a minute. But I'll go to Todd. Todd, you've got about $3 billion, if I'm correct, in the Aussie equity market, $2 billion at the top end, where you've traditionally been, and about another $1 billion in those smaller mid to smalls. Yep. How are you thinking about the equity market? Because Soul Pats have always been keep a little bit of cash in reserve, buy when there's a good opportunity. I kind of get the feeling that that's not the place at the moment, given the valuations.
Yeah, I agree with Phil that if you had a very equity-centric portfolio that was focused on the top end, I'd be a little bit nervous right now. So for us, it's always been about creating an evergreen portfolio. We're not really into picking the market timing. We're really trying to create a portfolio that will perform through any economic cycle and has that resilience about it. For us, large caps is not necessarily about generating huge amounts of alpha. It is about having that diversification, lower correlations, and it is a source of liquidity for us. It is one of the most liquid pools of capital that we have across the portfolio. So naturally, that's the thing that we've been selling down over the last few years to fund our entry into these other asset classes.
And should we expect you to stay around this level in terms of your exposure? Or do you use it as liquidity as opportunity?
Yeah, I mean, we've got plenty of liquidity and it's not the only source of liquidity. I mean, we do sell other assets, but I think it really depends on what new opportunities we look at. But it is fair to say that we're probably seeing better value outside of the top end, large cap equities, than we have historically, but that might change. I mean, there might be a correction and a sell-off and suddenly we go shopping for large cap equities again.
And just talk about liquidity, we were talking about it earlier, but Soul Pats have got about $1.5 billion that they deploy most years, is that correct? And
a bit more than that. So last year we did $5 billion in transactions, which were all self-funded, so roughly $2.5 billion of sales to fund $2.5 billion of deployment.
So you've got a few decisions to make. The money keeps coming.
It keeps coming in, and it's nice. I mean, we're now in a position where we can seize new opportunities that we see. That wasn't always the case. It was quite hard for us to find the capital. And we always had that discipline of needing to sell something to buy a new thing. We weren't in the habit of raising huge amounts of equity, and I think up until the last couple of years, we'd never raised equity in the history of the company. So it's always been about recycling, regenerating the balance sheet and just growing the portfolio. But we're now in a position where everything is capable of being sold. There's no sacred cows in the portfolio. There's no tax burden across the portfolio. So we're in a really nice position where we can fund whatever we see.
And is there anything you don't like in the portfolio that's not working?
Well, it wouldn't be there, frankly, if it was really not liked. I mean, that wasn't always the case. In the past, you'd sit there saying, I think I could get better value elsewhere, but if I sell that, then I can, I end up with 70 cents of every dollar that I sell. Well, that's not the case anymore.
Yeah, great. Phil, we've given you a couple of minutes there. Stocks in that small cap area, you might want to pick on resources, or you might want to go more broadly.
Yeah, look, lots of things we like at the moment. One stock I was, to be honest, just looking at that seems to be going up today is Chrysos, which has got some gold testing technology. Traditionally gold companies have used fire assay technology, but the CSIRO developed some photon assay technology that's a lot more environmentally friendly, quicker and more accurate than traditional technology, and the gold companies are loving this, and I think Chrysos will have a monopoly that'll develop over the next few years, and so they're in a great place, and Australia's got some great companies. They're just at the small end of the market, but that's one stock we could think that could even double or triple over the next year.
Well, it's a nice one, industrial but exposed to the resources.
Yeah.
So that's good. So we started with diversification, and I'd like to ask you both, do you see that your investment houses will continue to diversify over time? And if so, where are the opportunities? I might start with you, Phil. I mean, you've been, as I said, been doing it fairly quickly. Brendan's been, you had him out there running hard. Is there more opportunity for a Regal to grow in a diverse way?
Yeah, tremendous opportunity, we think. And the old saying in finance is that uncorrelated returns are the only free lunch in finance. And by that, we mean you can get some extra return for no extra risk. And certainly, I think there's tremendous opportunity to do more. We can grow some of our existing strategies, private credit, royalties, small caps. But there's also new areas we can go into. And, we've looked at things like private equity and infrastructure. We kind of have made the decision it's probably not the best time to be looking at these sort of asset classes. But, maybe when, there's interest rates go up a little bit more at the long end and there's a little bit more pain on the street, we could look at something like that as well.
So we've talked about this before, but probably worthwhile socialising. Uncorrelated returns is what everyone's after. That's the
free lunch.
The free lunch, that everyone would like to have. But I remember asking you, don't all assets get correlated at certain times in the cycle when there's a bit of a panic, or it might be during COVID, it might have been during the GFC, all of a sudden everything falls and the uncorrelated disappears. So how do we handle that?
Well, it's a great observation, and there is an element of that, and that's basically caused by, investors in trouble looking for liquidity. And so, I think that's where someone like Todd is in a really strong position because, he doesn't have that redemption risk. He's got permanent capital and he can take advantage of opportunities like that. And so I think, one thing I've learned is it's important to match your liabilities with your assets and to have your, redemption terms, appropriate. And so for some of our less liquid assets, whether it's royalties or private credit or emerging companies, we have longer dated redemption periods. And so I think, that's the goal. And then that avoids this notion that, everything's got a correlation of one.
Todd, I was going to ask you the same question, but Phil probably gave one of the great answers there, so I might put him on the payroll. But more seriously, the idea of continuing to diversify, you guys are pretty diverse. You own businesses outright, operating businesses, so slightly different model. Is there room to continue down that path for you guys?
I mean, I think we've got to where we wanted to get to. The strategy was all about replicating what all of the sophisticated family offices around the world do in a ASX listed stock that people can access on market and have daily liquidity. And so we now have exposure to all of the major asset classes. We can dial those up, dial those down, opportunity dependent, market dependent. We've got the liquidity across the portfolio to be able to do that. And so, I think we've achieved what we wanted to achieve, and from here it really just comes down to executing well.
Terrific. So we might go to questions now. I think the first one we've asked, why don't we go with Phil? Lessons. That's a bit pointed, because I remember seeing in the paper saying that you've learnt lessons a bit earlier in the year, but you might be a bit broader than that, and we're always learning lessons, all of us.
I'm always learning lessons, Matthew, and I guess one big lesson I've learned this year is don't invest in Opthia. So, look,
A bit unfair from us, sorry. I didn't know the question was coming.
No, that's all right, We're always trying to learn. And I think when you stop improving, I think you stop being a good investor. But yeah, always learning about new stocks, new technologies, and that's the exciting part of my job. So I'm learning lessons every day and learning lots of new things. So we're in a great place at the moment. We had a bit of a drawdown earlier in the year, but we've bounced back incredibly strongly, and we're in a very strong position.
Yeah, it's been an incredible bounce back. You've done well. Phil, I'll stick with you, which is a little bit what we've touched upon, around that idea, the industry funds, the battle with the industry funds. You brought it up where they're buying the top 50 stocks. How do small caps get from under that kind of cover and actually perform? That said, the last year, small caps have done pretty well.
Yeah, small caps, I think, had one of their best months ever in, August? Up 8%, outperforming the broader market by 6%. So there are some signs it's changing. And, we have seen a tremendous amount of selling in small caps. And it's not, I think the question should not be when does this selling cease? It's when does the rate of change of selling start to slow down? And I think we might be through that inflection point. And it certainly feels very, very positive. We've talked about the bubble in passive investing, and, some of those stocks that are joining the 200 index, if you exclude the foreign stocks, the other 6 or so are up on average 111% in the last 12 months, which to us just signifies how strong the bubble in passive is, and also the great opportunity you have in small caps if you can identify opportunities before they join the index. And so, lots of opportunities still out there in small caps.
So, Todd, to bring you in, there's a question that came up, revealing an investment opportunity in asset class beyond private credit you're eyeing. I know you just told us that you're pretty well full in, but what do you see as the best opportunities over the next couple of years? Which part of your business is really humming at the moment?
Yeah, it's not that we're full in private credit. If I could allocate double to it, I would. It's just that the nature of the opportunities are hard to get. We categorise our private credit portfolio as picking the high-hanging fruit. It's not easy. It takes a big team. It takes a lot of work, a lot of diligence, a lot of structuring. A lot of those deals are originated by our team. We're sort of up to $1.5 billion now, but it's not easy for us to just go out into the street and get more of that. So we're spending a lot of time trying to build it as fast as we can. Of course, you get paid back every couple of years, and the better the loan that you write, the more likely you are to get repaid because the company's doing better and they can go get cheaper finance at some point, so they want to pay you back. But it's been an asset class that's been generating 13-14% for us for the last 3 years, which is phenomenal for the risk that we're talking about. And we take, as I said, a more equity-like lens to the company. But so far that's been working really well for us.
Just an adjunct, someone else put a question in there about gearing private credit. So Phil made the point that the bank's 20 times geared while the private credit funds aren't geared.
Yeah.
Soul Pats do their own style. Are they happy to gear into, borrow money to put into private credit?
We don't typically gear our returns. We're looking to generate real returns. We don't gear our private credit. There are a lot of private credit funds that will take more sort of investment grade opportunities and then lever them up, and that's how you get to maybe a 9-10% return, and that's okay, but it's not the way that we want to generate our returns. We want to get fundamentally the fundamentals generating the returns rather than getting it through leverage, which is similarly applied to our private equity portfolio too. We are not putting lots of investment leverage into. We'll put normal amounts of operating leverage into the businesses, but we're not trying to get our returns through leverage.
Which is not the normal
typical,
private equity
no.
model. That's right. Well, that half an hour's flown, gentlemen. It's been terrific. Todd, good luck tomorrow with your vote.
Thank you.
It'll be a bit of a sad day. The courting process is over, and now the marriage is on between Brickworks and Soul Patts after all the years. And Phil, thank you very much. It's been a terrific conversation. So if everyone could give the two gentlemen a round of applause.